Welcome to another Options 101 video where we go into the basics of trading options. And in this episode, we're going to take a look at basic uses for a put, when to use it, and how to kind of use it and apply it in a couple of cases to either protect your stock or use it maybe as a synthetic position. So that's what we're going to go ahead and cover. If you're brand new to trading options, I highly encourage you to check out our website. There's a lot of great freebies, downloads, mini courses, and just a lot of great stuff to get you started into trading options. Anyways, with that being said, let's go ahead and take a look at some of the cases behind it. The first thing and first reason for getting the put is to protect the stock from crashing and losing a ton of money. Now, in this situation, what I've got is this simulated account. Now, in the simulated account, we've got a lot of different positions. And some of those positions are fairly profitable. So I put these positions months ago and I just kind of let them sit. And as I do different coaching, mentoring sessions and work with people one-on-one, we kind of review certain things on screen. So I always have some positions kind of going. So one of the use cases for these positions to protect that stock is we could go ahead and take, let's say, NVIDIA right here. And we can protect the stock from crashing and losing a ton of money. So I bought this stock. This is 600 shares of NVIDIA. It's probably one of my largest winnings for this simulated account is almost $89,000. So if we go to the trade tab here and we look at NVIDIA and I look at my positions, you can see I got that stock at around 148. That stock's at 400 and some dollars. So what I can do now is, because I've got such a large position, I can go in and look at all these positions I got. I got a ton of different positions actually on this. But if I want to protect that stock position, what I can do is go in and buy some puts to protect it. So right now, what the put will do is it will say, hey, if the stock crashes to 400, you can put that stock to somebody else. So that's what we're going to do is we're going to go in and I'm going to go maybe about 49 days out. And I can say, hey, at 400, protect me. So I will go over there and put in a few positions. I'm going to do 6 contracts because I got 600 shares of stock, and I can do it this way. And what that's doing, actually, it's converting me to a call position in theory. Now I just have kind of calls, but it looks very similar. So if you're a little more advanced, this looks like a call. And if the stock crashes, I don't lose much more than this. Okay, so I'll still be profitable, 143,000 in this case. But if the stock kept going down, I'd only be profitable $111,000. Whereas right now it's profitable about $190,000. So what you can do is go in and put in a protective put over here. And as that stock falls, it flatlines you right there. And that's one way of doing it. So I'll go in, I'll put in an order, I'll send that in. The market's going to open in about 2 minutes. So I'll let those sit. So if you look at this from hey, let's say we had a brand new position, I'm just going to put in Citigroup. What we're doing is if we bought 100 shares of stock and we go into 100 shares of stock right now, if that stock kept crashing to 44, I'd lose about $424. But what I can do is buy a protective put at around 46 and analyze that. And you can see if we crashed to 44, I'd lose 425. But with this protective put, if it crashed to 44, the most I could lose is 337. You can see the biggest loss I'd have is 337. So it saves you a bit. And if the stock gets to, let's say, 38, the most I can lose is 337. But without it, if it gets to 38, I lose $1,000. So do you want to lose $337 or $1,000? So that's kind of part one to doing a put. And the way that I would execute it is if I had these 100 shares, all I would do is just double click the put and then send that order in. Anyway, that's the approach. The problem with it is you pay some money to insure the stock. And every day, the value of that insurance goes down. So it loses about $2 a day. And at the end of it, it might be worthless, but what you're doing is you're protecting your stock. Just like insurance, you're paying for it. Okay. Reason number 2 is use it as a synthetic or bearish position. Let's say you didn't have stock. What you can actually do is just buy a put on its own. And I can buy a put, let's say at the $50 range here for Citigroup here. And if it crashes or just goes down, I could just be bearish on it. It uses less capital than shorting the stock or going in and just, doing it with shares. And if it goes down, you make money. So rather than actually buying the stock or shorting the stock for a short position, when we're talking about puts, we're actually just creating a synthetic short position of about 62 shares, because that's what the delta is on this one. So if it continues to head lower, I make money about $62 for every dollar move down, plus a little bit of vega and take off some theta. So as it goes down, I'm basically short that stock. And this is another way of doing it. It's a lot cheaper because your max loss here is what you pay. So that's $335 for me. So it's $335 there. So that's another way of doing it where you don't have to deal with the stock. If you just want to go in and just go with it this way, you could do it that way. That's kind of the second version. Ultimately, what you're doing is if you actually had that stock, and we'll go back to 100 shares, and we will analyze it right here. What you're doing is really cutting the deltas. So if I had 100 shares of stock, I am 100 delta long. And then if I go in and do the put right here, it sells off and I'm negative 61 delta. So together, I'm actually just cutting my delta by 60 or so. So I only have a positive 40 delta when I'm long the stock. So in either case, this is the approach when we're looking at option trading. This is what's happening is that we're cutting the delta when we're buying a put. So you can either A, buy the put to protect the stock, or B, second version is go ahead and use it as a delta hedge, or even use it as a synthetic position for a short. So those are a couple of basic ways to use the put. Yes, there are other ways to do it, to construct verticals, iron condors, and many other things. But from a basic level, most people would use the put as a protective means or a directional bet for a stock that's heading lower. Anyways, if you want to check out some great brand new trading webinars for learning more about options, check out tradingwebinars.co, and you can take a look at that on the website. It's absolutely free. You can go ahead and get yourself started. There's a lot to learn there, and we just made that website just to have some free video content for you guys that are more long and in-depth to learn more about options. Anyways, thank you so much for joining me. Truly appreciate it, and I will see you next time. Take care.